There's a financial tool out there that can take your mortgage and turn it into a hot, sellable investment. But here's the catch. It also has the power to bring down the entire global economy. Yeah. So today, let's dive deep into the fascinating and, let's be honest, sometimes dangerous world of securitization. Okay, so to really get this, let's put ourselves in the shoes of a giant bank, right? Imagine you've got a million different home loans sitting on your books. I mean, that is just a messy pile of paperwork. Every single one has its own interest rate, its own payment schedule. It's a headache. Now, picture a huge pension fund with billions to invest. They're not going to sift through that mess. No way. They want something simple, something clean, something they can buy and sell with a single click. So the big question is, how do you turn that giant, messy pile of loans into an investment that actually looks, well, attractive? Well, the answer is a kind of financial magic trick called securitization. It's the process of taking all these assets that are really hard to sell, think car loans, mortgages, bundling them up, and transforming them into these standardized bonds, or securities, that investors anywhere in the world can easily trade. And yeah, while it's totally infamous for its starring role in the 2008 financial crisis, it's also the secret sauce that financed the entire global mobile phone boom. Pretty wild, right? But before we get into the nitty-gritty of how this all works, let's just take a step back for a second. We need to understand the problem it was designed to solve in the first place. I mean, why did bankers even invent this thing? So, a bank's balance sheet is a really tricky thing to manage. It's packed with all these valuable assets, all those loans, that generate a nice steady stream of cash. But here's the problem. That cash just trickles in, slowly, over decades, and that ties up a ton of money that the bank could be using right now to make new loans and, grow its business. On top of that, all their risk is concentrated in one place, and regulations force them to hold all this costly capital against those loans, which just eats into their profit.
So how did bankers solve this big puzzle? Well, they came up with a really ingenious solution. They invented a special kind of company that basically acts like a financial magic box.
This magic box has a name. It's called a special purpose vehicle, or an SPV for short. Now, you can think of it like a mini bank, but with a single laser-focused purpose: to buy a specific pool of assets, like mortgages, and then issue bonds that are backed by them. And here's the absolute key difference. An SPV's credit rating is tied only to the quality of those specific assets inside it, not the bank that created it. It's a totally separate entity, basically running on autopilot.
Okay, so how does this SPV actually achieve that magical separation from the bank? How does it become this kind of financial fortress, completely immune to the fortunes, or the misfortunes, of its creator? It all comes down to creating this really powerful legal firewall between the bank and the SPV. And this whole concept is known as bankruptcy remoteness. It's built in 4 critical layers. First, the bank has to truly sell the assets to the SPV. Legally, they can't take them back. Second, the SPV is made an orphan. It's owned by a trust, so it literally has no parent company. Third, independent directors are put in charge. And finally, investors know from day one they can only ever claim the assets inside the box and never the bank's own assets. So yeah, it's completely walled off. All right, so we've seen how this whole thing works. But why go through all this trouble? What are the actual benefits of this complex financial machinery? Well, when it's used correctly, securitization can be a really powerful force for good in the economy. The benefits are actually huge. For banks, it's a fantastic way to unlock cash that's tied up, transfer risk off their books, and get cheaper funding. And you know what that can mean? More and cheaper loans for all of us, whether we're buying a car or a house. And for investors, it opens up a whole new world of opportunities. It allows them to fine-tune their portfolios and manage their risk with some pretty incredible precision.
And this isn't some newfangled, risky invention either. The Germans have been using a form of securitization called the Pfandbrief for over 2 centuries. 200 years. It's been a rock-solid pillar of their banking system that whole time. So this is a tried-and-true financial tool.
Okay, so if securitization is such a great tool with this long, stable history, why did it all go so horribly wrong in 2008? What turned this brilliant financial innovation into, well, a weapon of mass destruction? This quote right here, it gets right to the heart of the problem. When the original lender knows they can just package up a loan and sell it off to someone else, their incentive to make sure that loan is actually high quality, well, it shrinks dramatically. They get their fee up front, and the risk gets passed on to some distant, unsuspecting investor. And that is exactly what happened. The system basically became a giant sausage factory, just churning out billions and billions of dollars in securities that were backed by these toxic subprime mortgages. So, when the housing market finally crashed, the value of those securities just evaporated, and the whole thing came tumbling down, triggering a global financial meltdown.
150 times. That was the insane level of leverage some of these investment vehicles reached. I mean, they had borrowed $150 for every $1 of their own capital. Just think about that. That means a loss of less than 1% on their assets could completely wipe out their entire capital base. The system had absolutely zero margin for error.
So you see, it wasn't the tool itself that was really the problem. It was the way it was being used. It was this toxic cocktail of really poor quality assets, amplified by extreme leverage, all hidden inside these complex black boxes, and then given a stamp of approval by flawed credit ratings. It was a recipe for disaster.
So what happened after the crisis? Did this powerful and now totally infamous technology just disappear?
No, far from it. In what might be a surprising twist, the tool actually became even more mainstream. Central banks all around the world, like the US Federal Reserve and the European Central Bank, they now use securitization themselves. It's one of their primary ways to provide cash to the banking system and keep our economies running smoothly.
The crisis taught some painful but really valuable lessons, and that resulted in a whole wave of reforms. So now, there are far greater requirements for transparency. Credit rating agencies have to use much tougher stress-tested models. That extreme leverage we saw, it's now regulated. And finally, the financial health of the company that's actually creating the security is taken into account.
So where does that leave us? Have we learned our lesson? The tool of securitization has been rebuilt, sure, with more safety features. But at the end of the day, it's still just a tool. And like any powerful tool, it can be used to build or to destroy. The future of our financial system really depends on our ability to use this one wisely.